Hello, everyone, and welcome to the channel on this lovely New Year's Eve day. This is the first video of the channel, so please do excuse the quality. Haven't quite got everything down yet, but I was thinking hard about wanting to start doing some ETF reviews before the new year. So this is that in uh, attempt mode. This is what I'm attempting to do. And I thought long and hard about what ETF to do it on. And as you can see, I chose GIAX. And here's why I chose GIAX. I love this fund. I love its holdings. I love its strategy. It does everything that I want in a fund. But there's a big, big but. And we'll go over that but a little bit later. But first, let's dive into GIAX. It is the Nicholas Global Equity and Income Fund. So the fund summary, it is by X Funds. They're also the creator of Blocks, and they have another one for like fixed income. Um, just scrolling through the fund's objectives, it's global equities. You don't really see that very often. I think NEOS has one, NIHI, that does global equities, but it tracks just global equities. No, European equities, developed markets. And that's good, but I want a little bit of any. I want a little bit of both U.S., global, developing, non-developing, and we'll get into that. So it has a global equities options overlay, weekly income. What is there not to like? What is there not to like? It's actively managed. It uses call spreads, which I really like. Unlike covered calls, which cap you out, call spreads give you a little bit more room for appreciation. And in their pitch deck, they said that they write them like 1% out of the money and then move and then give it about 1% out of the money and then it goes up to 5%. And they make some money there and it's not as capped as a traditional covered call. Some covered calls right directly at the money, like a lot of the yield max funds. Shout outs to the yield max people. They write them right at the money and they get these incredible years. But if you write it slightly out of the money and you use the spread technique, one, you define your risk, but two, you're able to get more price appreciation, which is very important to an investor like me. I'm all about growth and income. But moving on, they use call spreads. One thing that they changed, and they changed this in November, is that they changed the prospectus to allow for credit spreads. Now, if you don't use credit spreads in your options investing, it is probably one of the best ways to make just raw money. Besides insider trading and finding out about a stock that just skyrockets, finding a penny stock that grows up to be one of the Magnificent Seven. Outside of doing that, this is hands down. Put credit spreads are the hands down one of the best ways to make money, to bring in that income and to bring it in fast. It I use put credit spreads. I run put credit spreads myself. The thing about put credit spreads is that they are winner take all. If the market goes below your strike price, you you lose. You lose. It goes below your long strike, your short strike, you lose. You just lose that money. Point blank period. You keep the premium, which is might be, let's say, couple $100, depending on how much you put up, how much your investment, how many options you bought, but you lose. You lose all the money. There is no, like in a covered call. Well, the stock gets called away from you, but you keep the income. You keep the income and you keep the money from selling all that stock to somebody else. But with a put credit spread, if it breaks your strike prices, you're done. You're done. So it is risky. So when I found out that GIAX was doing both call spreads and put spreads in an ETF wrapper, I was very, very intrigued. I really, really like that fund. I really like its option overlay, and I really liked some of its positions. And why choose between income or growth? This is one of the best models because I am an income and growth investor. I'm a huge fan of the Devo series, but Devo just does cover calls. But if you can play both sides of the market, cover calls and put credit spreads. Hey, I mean, call credit spreads and put credit spreads. You're really winning. And this expense ratio, I know a lot of my fire investors, my VT and chill, or VTI and chill, or VU investors are going to look at this expense ratio and say, absolutely not. But for what you're getting, this is relatively cheap. This is relatively cheap to run call spreads and put credit spreads over a diversified holding. You're not going to find that in too many other places. So let's just take a look at, we'll get back to that NAV, but we'll take a look at its distributions. As you can see, this fund distributes weekly weekly. So every Monday, you're going to get a check. You're going to see your brokerage. It'll be every Saturday or Sunday, it'll show a dividend pending, which is really, really nice. It rewards you. It helps you stay in the markets when they're going up, when they're going down. And that's just a really good feeling. Some people investing is half psychological, and there's the best investment is the one that you can stick to. And when you're making money, it's easy to stick to it. So let's just take a look at their holdings. So you got the Vanguard Developed Markets ETF. So that's going to be your basically Europe, Australia, Japan, and sometimes it includes Canada. So it's developed markets. You're looking at Germany, Italy, Britain, Spain, all of Europe, and then you're looking at Australia and you're looking at Japan. And overseas has been having a great, great year in 2025, the year that's closing. Hopefully, they have another great 2026. Moving on, you have the emerging market, the Freedom 100 emerging markets. This fund r- has an interesting strategy. It ranks the countries based off of the freedom index that the UN puts together, and then they buy inside of those countries. So if you have a lot of free speech, if you have a lot of free economic, free movement, you get ranked higher. And this is in developed markets, I mean in developing markets. So with these two, you cover developed markets and emerging markets. And that's it's just a really, really good fund, especially if you want to avoid authoritarian states, if you want to avoid a lot of state ownership inside of your equities, like if you want to avoid China for whatever reason, the CCP can say, hey, um, Tencent, you're closed, or they can say, Alibaba, you're closed. With this fund, you avoid that risk, right? Then you have the small cap. Vanguard small cap, S&P 500, of course, Vanguard mid cap. So right there, you're covering the entire U.S. market. Actually, that's the mid cap growth fund. But right here, you're covering probably 90% of the 80% of the U.S. investable market. And then you have VUG, which is the Vanguard Growth uh, ETF, and then you have Palantir, Tesla, Meta, Taiwan Semi. These are excellent names. And like I said, I loved this fund because of its holdings. There is no other fund out there that has these type of holdings and are running both call credit spreads and put credit spreads. I downloaded the holdings, so we're going to take a closer look at those holdings so you can get an idea of what's going on here. So right here, you see the holdings. I think we stopped at Taiwan Semi, and then you have Robinhood, Nvidia, Alphabet, Microsoft, Amazon, Nebius Group, Apple, Broadcom, Iron, Open Door, and then they hold some treasuries. Now, these holdings are ideal. This is just your perfect globally diversified ETF with a tech tilt. It's positioned to do incredible. But we're gonna scroll down just a tad bit, and here we see the options. So you got a put option on Nebius, you got another put on Iron, you got a call on VUG, a call on VB, which is the US small cap. I forgot to mention that their strategy is to write call spreads on the ETFs in the fund, and then they write put credit spreads on the individual holdings. So just to go over that one more time, the fund is basically split in two. You have the ETF half sleeve, and then you have the single stock sleeve. They write call spreads on the ETF half, and they write put credit spreads on the individual stocks. And you can see they're busy writing them. Here's another put credit spread on Robinhood, another call. Well, this is actually a put on VB. I thought they did a call. Actually, yeah, they did a call. Well, it's creating the spread, but more put options, more call options, and they really kind of write over a lot of the portfolio. They write their call credit spreads over a lot of the portfolio, and they do their put credit spreads on a lot of the portfolio, which is fine with put credit spreads. You can write those all day. It doesn't cap you. And the call credit spreads really, I mean, even if you are capped, you still have room to grow. I really have a issue with the way people talk about call options and being capped. It's like, yes, if you write at the money, you are 100% capped. But if you're writing your options 5% out on, some stock on at a week of expiration, a week till expiration, you're fine. I mean, for sometimes, on other times you're not. But realistically, if you write a call option 5% out of the money on Coca-Cola, are you really capped or are you just bringing in the dough? I use the analogy. It's like if I walk into a skyscraper, yes, technically I am capped. I can't go to the clouds, but I can't jump that high. I mean, nobody can. So while you are capped technically, it's like realistically, are these stocks really going to move like that, depending on where you place your strike price? Now, let's take a look at GIAX on Seeking Alpha. I use this tool. It's a little pricey, but it's 100% worth it. You can see here where the problem comes from. This is going to show you where the problem comes from. Yield, 25.5%. Coupled with this is old. It's saying dividend frequency is monthly, but it's weekly. So they're yielding 25% and they're paying it out monthly. And this is why you see the stock price doing what it's doing. It's not moving sideways. It is moving down. It is making lower highs and higher lows. It is driving itself into the ground. And that's the uh, that's what ruined this fund for me. I really loved it. I really like its holdings. I like its option strategy, but as a growth and income investor, I need that growth. I actually wrote a letter to email to the fund managers asking them to lower the yield, put it at 10, 15 to 10%, and let's get some price appreciation. Now, in terms of, let's go ahead and do a comparison right quick with GIAX. I'm going to show you guys what this has done, um, what it's done in total returns, because this is just price appreciation. You see, you have negative 12.08 price appreciation. But in total returns, you did get 11%. Now, if you compare that with VTI, I'm sorry, VT, which is just the total global world stock market, you're trailing. You're trailing significantly. You are trailing significantly. 11% return, 22% return. So these caps, it is capping itself hard. It is capping itself hard. Something about the call credit spreads are not working, or you're not generating enough money from the put credit spreads to do these 25% weekly payouts. It's just not working. The strategy is not working. And it's such a shame because it has such amazing holdings. Now, Seeking Alpha grades it I mean, this is basically a F. D momentum, D expenses, A in dividends because it is a good dividend payer. C for risk, C for liquidity. The spreads are kind of wide, and you'll just see in terms of performance, it's just losing every single month, month over month, just losing. Now, I want to go back to the website so we can talk about the NAV. Price decay, NAV decay, we're going to talk about it all. So I want to talk about GIAX NAV. What you'll see here is that what they're saying is that over uh, year to date, the NAV is up 13.29%. And also since inception, they're saying that it's up 12.5%. And these numbers look good. And this was one of the things that had me very excited about this fund was that it didn't seem to suffer NAV decay until I learned what this is. This is the NAV with dividends reinvested. Now, we know that dividends were not reinvested because dividends were paid out. So what's actually happening is the gap between they're paying you out of the NAV. That's what's happening. And that's why the price of the stock keeps going down. That's why the price of the stock keeps going down because they can't keep up with these payments. Now, when I tell you guys I liked this fund, I really like this fund. And one thing I want to show you from Seeking Alpha is just the ratios that they have. So go back to this and we're going to click on its holdings and we can look at the percentages. So between you got about 17% international, 7% mid cap. I mean, sorry, small cap, 7% VU, 7% mid cap growth, 7% just regular growth, and then you have your single shares, and that makes up about 63% of the fund. Now, I liked this fund so much. I'm going to show you what I did. Do you guys want to see what I did? I went and made my own. I made my homegrown version of GIAX. Now I had to adjust some things because this is an actual portfolio and I'm not a big fan of single stocks. I don't really do single stocks at all. But this is my homemade GIAX and I wish I would have captured it. I actually call this is in Fidelity's baskets. I call this Savvy GIAX because and I'll go through the holdings and you guys will see why I call it savvy because I think it's the smarter way to run this fund. To be honest, I'm no professional fund manager. This is not investment advice. Everything you're hearing is just my opinion and some of my analysis. Take it, use it for what you will. But I think that this is a better version of the fund. And if you like, many people like GIAX a lot, but kind of don't want to see that NAV erosion, this is a way that perhaps you can make it yourself. So I want to go through the fund and talk about some of the things that it has. So as you can see, the top holding is VU, which is the S&P 500 at 40%. Next, you see VEA, which is the developed markets ETF, very similar to what they have. And then you hit the first thing that's different, which is MAGS. MAGS is the Round Hill's Magnificent Seven. It gives you direct exposure to the Magnificent Seven. I think it holds about 14% of each. And from what I understand, their positions are synthetic. So, do with that information what you will, but you do get the exposure to all the MAGs. And it's in the ETF wrapper, so you don't have to go individually buy each share. And then I have the Freedom 100, and then I have at 7%, and then I have AIQ. AIQ is what I'm using to get the similar exposure that they have to Taiwan Semi and to Palantir. Now, it has a bunch of other really good stuff that I like inside of it, but that's the primary reason I wanted to get AIQ was because it has large chunks of those two ETFs inside of it. Is Palantir overpriced? Does it have room to grow? I don't know. I do. I don't bet against Palantir as of right now. It may have a price correction, but I think in the long term, it's gonna probably prevail. And then we have VB, just like GIX, as it's the small cap. And then I replaced VUG for AOTG. And I replaced it for a couple reasons. One, because this ETF has my Savvy GIAX has a higher percentage of VU, which is already large cap growth funds, and VUG is built, I mean, it's weighted slightly different, but it's very similar to the S&P 500 and would have very similar names in it across sectors. I already have enough of that in VU, and I wanted to tilt. And I think what GIX is using VUG for is growth. So I went and found AOTG. It is a very dynamic fund. I'm going to do a review of it soon and go into depths about its holdings. But it's interesting because it goes across caps, market caps. So it'll do your large cap growth funds, but it'll also have some smaller names in there, some mid tier things like Robinhood, AppLovin, and a couple other individual stocks that I think have lots and lots of potential. And I don't know if you guys looked up the stats on AOTG, but it's been crushing everything. It's been crushing everything. Can it keep it up? I don't know. But so far, so good for about 3 years now. And then I have BOT, which is the small cap growth. And then I know a lot of everybody sees what's at the bottom. And yes, that is Block. That is their crypto ETF from X funds, the very fund that I said that I do not want because of the NAV erosion that goes on in GIAX. Blocks run actually had the strategy, the call credit spreads and the put credit spreads before um, before GIAX had it, and they amended the they amended the prospectus to be more like Blocks. Blocks has both Bitcoin and Ethereum, and then they have a lot of the enabler names. So they'll have your Coinbase, they'll have Robinhood, they'll have some of the miners and some of the energy companies that make the crypto space work. They have that there, and they run the put credit spreads the exact same way. The put credit spreads and the options overlay the exact same way. They run um, they run call credit spreads on the underlyings of Bitcoin and Ethereum, and then they run put credit spreads on the individual holdings. Why is this in my portfolio? The answer is simple. I am a growth and income investor, and I genuinely do like their options overlay. And I think that Blocks has the volatility necessary when it moves. It has the volatility necessary in order to make the strategy work, because Bitcoin and Ethereum can skyrocket. They can skyrocket and you'll get the price appreciation. Also, if you look in the prospectus, and I didn't say this when we were going over at the website, but I didn't say this, but Blox's primary objective is price appreciation, followed by income. GIX primary goal is current income followed by price appreciation. So that is the reason it's in my portfolio. I think it yields 34%, which is very high, but it's also wildly popular. And I think it has a bright future. You don't have to put Blocks in. If you decide to copy this, you don't have to put Blocks in there. You can put something that works, that we know works, like BTCI in there. You could put a gold ETF in there and have just as well-rounded Savvy GIAX. It's truly global. It's truly diversified, and I think it'll serve you well. So I started this on New Year's Eve 2025, and we'll be checking back in every quarter to see what what the fund actually does, and I want to compare it to the actual GIAX. But this is my first video, so happy New Year's. I pray that God blesses you all immensely in the new year. And thank you for coming to Implied Investing. Please like, subscribe, comment, do all the things. Thank you and have a blessed day. And stay safe. Stay safe.